welcome to today's live technical analysis. We're going to be combining today's analysis with fundamentals. Um, Personally, I'd like to start off with the US dollar index. On the daily, it appears to be moving in a downwards fashion. If we look over to the other pairs at this point in time, so we're going to be checking cable, the euro dollar, and the dollar against the Japanese yen. So the euro appears to be regaining some strength against the dollar. Interestingly, the Joel Show openings figure that came in yesterday was better than expected, hinting at a resilient labor market in the U.S. economy. Therefore, given that the bank's next meeting is due at the end of the month, if I'm not mistaken, on the 1st of November, where this decision is due to be taken, we may see a slightly more hawkish sentiment emerging from Fed officials. Yet we should note that they do appear at this point in time to be relatively uncertain as to whether or not they're going to be hiking. We're seeing the euro gaining some strength against the dollar. The cable, so the British pound against the US dollar, appears to be gaining as well, aiming for our R1 resistance level of 1.2125. The euro appears to have bounced off our support level at 1.0460. So for the pound, RSI near 50, which may imply a neutral market sentiment, currently aiming to test resistance at R1. So on a more fundamental level for the British pound, traders who may be interested in this pair may be looking at today's Conservative Party's conference that is going on. Essentially, Prime Minister Rishi Sunak is expected to announce a new infrastructure deal following concerns about his potential cancellation of the second part of the HS2 railway, which connects London up to Manchester. So, in regards to cutting the HS2, one, it could be attributed to increased costs, which is interesting considering that the current government was in charge of procuring those costs and maintaining them in a sustainable level. Therefore, it may be interesting to see what political impact this may have. From a more technical view, so in an FX related way, we could say that by cutting the government's costs, you could increase the revenue, well, decreasing their loss, perhaps spending on somewhere else to improve the economy, which may stimulate growth, etc., etc., etc. Still, I still persist and believe that the UK economy is facing some issues. So if they do cut the plan, nothing too major. I still expect the British pound over the long run to weaken. It is also validated on a technical level from our downwards moving trend line, which has still to be broken. Is still at the mid-range of the Bollinger Band, which coincides with our R1 level of 1.2125. So if it breaks above, that could be a bullish outlook. But if it simply tests R1 and then moves lower, maintaining our bearish outlook. On a weekly time frame, we're seeing that the British pound continues to move in a downwards fashion. The RSI is near the level of 30, implying a strong bearish market sentiment. So from a fundamental and from a technical point of view, I would be maintaining a bearish outlook for the British pound. Perhaps it's due a small market correction to higher ground in order to gain some liquidity before moving lower. So moving on, something that may be very interesting for the for the majority of traders could be the dollar against the Japanese yen. So before we continue, place these levels perhaps on your charts as well so you can follow along. We have our S1 level at 148.40, S2 147.50, S3 146.20. So you most probably have noticed that something is amiss with this image. The wick that reached down to S2. This was roughly 250 pips, a 250 pip move within a day. As you can see from the open, 259 pips. A huge sum. Note how it's validated our resistance level of 149.90 beautifully to the opening and closing of the bullish and bearish candles. It actually came back down to S2 before moving back up again. It's It's validating our upwards moving trend line. But from a fundamental point of view, it appears to be moving in a downwards fashion. On a technical as well, this could be market correction and then continues to move in a downwards fashion. So, what's interesting about the dollar against the Japanese yen? We've had no official announcements of a government intervention, but 259 pips looks like a government intervention. It looks like they intervened in the FX market, but they're simply not willing to admit it. And why could that be? Well, yesterday, the government's FX strategist as well had stated that they do not want to engage in the market when there's low volatility. And there was low volatility yesterday. Excuse me, low liquidity. So it would have, according to them, they would have not intervened. But this move here appears to be a government intervention. They may be gauging the market's reaction to yesterday's intervention in order to see whether or not it's needed again. So if they had, hypothetically speaking, if they had intervened here, which I believe they may have, and then the pair continued moving in a downward trajectory, so staying around S2, coming perhaps back to S1 before moving lower, then they may have admitted that it was a government intervention. But since it rebounds almost immediately, forming this bearish candle at this point, they may be concerned that it may have not been enough. Therefore, based on a based on my opinion, I think that they may intervene once more. If it comes back up to this level on R1, we may see a government intervention occurring. And on the second time, they may make it official. For now, this is simply speculation. It's a hypothesis. There could have been hedge funds, investment managers, individuals with a huge amount of capital, essentially pushing the pair down, or market anticipation at this level that there would have been a government intervention. So that could also be a reason. But personally, I think it was a government intervention. They're just not admitting it. So even if it does move higher, from a fundamental point of view, I would expect it to continue moving lower. For a bearish outlook, it would need to break below S1 and move towards S2. RSI still near 50 may imply a neutral market sentiment for now between S1 and R1, but I still think it's going to move in a downwards fashion, aiming for S2. However, if I am wrong and it moves higher, I would expect it to break above R1, and if it breaks and makes a clear break above R1, not simply a wick, a clear break with a bullish or a bearish candle above this level, then the next target for the bulls may be the $151.90 mark. The Australian dollar, so the Aussie against the US dollar, appears to me to have broken our downwards moving trend line. So having broken above and bounced off S1, I would be expecting and maintaining a neutral market sentiment. So essentially a sideways fashion for the pair, but it would need to aim for R1, fail to break above R1, and then a sideways motion could be validated. For a bullish outlook, breaking above R1, moving towards R2. S1, S2. For a bearish outlook, breaking below S1, moving towards S2. Interestingly, the Dow Jones 30 has actually erased this year's gains. So what do we mean by erasing this year's gains? If you open up your charts and move it to a daily, the US 30 cash, so the Dow Jones 30, draw this level here and see how that wick dropped through. And this was on the 6th of January. So the gains made by the Dow Jones 30 throughout the year up until this point in time have been virtually erased. So this could be of concern to the equities markets. If you look at the S&P 500 as well, note our support and resistance levels that were placed. It's broken below S1, so I would be expecting it to move towards S2. If we go on, actually, let's see at which point it's reached. So taking that wick. Also, beginning of the year, they've erased gains made throughout the year. The cable has actually just broken above R1. So for cable, we could even place R1 slightly higher. So for a bullish outlook, it need to break. Let's just keep it as it is, actually, at least for now. At the end of our live technical analysis, we'll come back to this pair. Let's see how it moves by the time we're finished. So Dow Jones 30, S&P 500, and the Nasdaq 100 probably as well. Let's at which point at the beginning of the year as well. So they've erased any gains that they've made virtually. So returning to the beginning of the year. From a more macro level, I'll be maintaining a bearish outlook for the US equities markets. I think that the US economy is in trouble despite the JOLTS job openings figures coming in higher. I expect, based on that, that the ADP NFP figure is going to come in higher than expected. What would be interesting for today would be the ISM non-manufacturing PMI figure coming in lower than expected. That could jolt the markets slightly, but from a general trend, we're seeing that the US equities markets are moving in a downwards fashion. Moving on to oil, we see that the crude oil has bounced off S1, so the 86.90 level. It is validating our downwards moving trend line from the swing high. So I would still maintain a bearish outlook despite this small correction, simply gaining some liquidity, and then perhaps pushing lower, breaking below S1 and moving towards S2. It is very interesting, though, given how much OPEC, and in particular Saudi Arabia and Russia, have tried to keep oil prices at a higher level in order to gain revenue, either by cutting production or, simply put, in the case of Russia, saying that we're cutting production, but not actually cutting production in order to push prices higher. Should it fall back to S2, then I would be a disappointment, I'd say, in my opinion, for OPEC. As you can see, it's moving in downward fashion. Perhaps we could place a downwards moving channel as well. Nope. The downwards moving channel will not be validated based on these three bearish candles, which makes it far too wide. But we're still maintaining a bearish outlook for the price of oil. Let's see. Gold may be oversold. It continues to be below the 30 RSI figure, implying a strong bearish market sentiment, but it was well below and is slightly gaining back up to 30, so there may be some slight bearish tendencies. It's broken below our previous support of S1 and S2. So from a technical view, we could be saying it's aiming for S3. But even if it does aim for S3, if the RSI continues in its upwards fashion, we may see a reversal and it may actually move higher back up to our previous S1 level. So for support at S1, I keep the 1,865 level. That would be S1. Then for S2, R2 and R1, 1,902 or 1,900 big figure. Then for R3, 1,945. For S1, switching to 1,819, validating this swing low. And then we're going to be looking for our new support level at S2. And why are we looking for a new one? Simply put, they're far too close to each other. So we'd like them to have some distance between the two support levels. That's beginning of this upwards moving trend line. 1,785 for S2. And then for S3, let's have a look for S3. So this might be one option. I'm trying to look for turning points. No. Hmm. After S2, the next level of support could be at the 1760 level. So I'll just go quickly through as to why I'm picking this level as S3. Placed here, not validated as much. We're ignoring this strong bearish candle. Placed here, we're ignoring the predominant move here. Placed at this point here. Perhaps it's validated by two bearish candles, a few wicks as well. But how significant could that level be? Placed at S3, then the distance. There are two options. So it's either at this swing high or at this swing low. In order to play it safe, I personally think that S3 would be at the 1740 level. The reason is I believe that if it does break below S2, then it may gain some strong momentum and move towards S3, which this would be far too close for S3 and S2 from a more macro perspective. So for now, we're maintaining a bearish outlook for the precious metal. Not even a downwards moving trend line. Excuse me, downwards moving channel, simply a downwards moving trend line. There we go. Currently testing support at S1 before potentially moving lower. Having broken below our previous support levels, we're going to be maintaining a bearish outlook for the short term for the precious metal, aiming for S2 and perhaps even S3 if it continues in this very steep downwards fashion. However, we note that it's still oversold, so it perhaps could be due a market correction higher if the RSI continues to move on the up and up. Let's look at a few other pairs as well. Facebook might be interesting. So for Facebook, the company, well, Meta, now Meta, announced that it may be considering, the company did not announce. It was reported by the Wall Street Journal, Reuters, and Bloomberg that the company is considering charging users on Facebook and Instagram about $14 a month for an ad-free version, essentially going towards a more blue check markish, now X, formerly Twitter style of social media platform. Essentially, if you don't want ads, pay us more money. This may be discouraging for many users who may not want to be paying $14 a month in order to have an ad free version of Instagram or Facebook, but it could boost the company's revenue income. And why? People may continue using the service, probably will, considering the fact that this happened with Twitter, now called X, where the users have still remained despite the despite the challenge mounted by Threads. So X has remained the dominant player between the two. And based on the appeal of Instagram, perhaps it may not lose that much of its customer base. Instead, it could increase revenue for the company. And as such, we may see the company's stock price gaining as they may increase their revenue over the long run. So perhaps some bullish market tendencies in the market. Could we maintain a bullish outlook? So we had placed previously support and resistance levels, but these need to be reevaluated. So let's just clear our chart from the support levels and the upwards moving trend line. Clear chart. So what are we looking for? From first glance, I can see a sideways moving channel having been formed. This point, perhaps slanting to the upside as well. This could potentially be a sideways moving channel. Let's also place in the Bollinger Bands as well. Narrowing of the Bollinger Bands, RSI fluctuating along the figure of 50 imply a neutral market sentiment. So for support, I'd place it around here, perhaps slightly higher than what we had placed. Coinciding with our sideways moving channel. $295. For S1. For S2, 279.50 or 280. 280 for S2. And then for S3, perhaps validated twice, came back to test support, found support, 260. There we go. So we have S1, S2, and S3. And then for R1, I place R1, the swing high here, $311. Perhaps 312 to coincide with the upper bound of our sideways moving channel, 312. For R2, perhaps we could place it at say $325. And R3. R3, just see here. Oh. And then I'd keep R3 at this level, 345, 346 actually. So for now, from a technical point of view, we would be maintaining a sideways outlook for the company stock price. So this is Facebook, aka Meta. Sideways fashion, narrowing of the Bollinger Bands, RSI fluctuating around the figure of 50, implying a neutral market sentiment. From more macro perspective, we may see the stock price moving in an upwards fashion due to the potential in increased ad revenue should they decide to implement the $14 a month for an ad-free version. We may see people signing up for it, and if they do, if it's a success, could increase their bottom line. Therefore, a better than expected earnings report for the quarter after it has been potentially implemented, which could be in the form of increased revenue, or they could increase dividends to shareholders, all of which could potentially boost the stock price to an upwards fashion. So breaking above R1, R2, and now we're going to be looking at perhaps Tesla, who missed, if I'm not mistaken, their expected car deliveries. Should be moving down relatively unchanged, moves slightly higher, moved down yesterday. Our support levels may be due a slight correction or a refresher, and then this one, and then I'd keep as 297 point, well, 198, and then for S3 I'd be provided with some space, 160, 165. So you have S1, S2, and S3. We're giving it some space in order for it to move, should it decide to move in a downward fashion rapidly. It's tested support at 234. It should be in the Bollinger Band should have narrowed. So let's just check that as well. There appear to be narrowing. It's at the mid range of the Bollinger Bands, which may imply neutral market sentiment. So we'd be maintaining perhaps a neutral outlook for the stock price for now. But if it continues to move back down to S1 at 234, for a bearish outlook, it would need to break below S1 and move towards S2. Whereas for a bullish outlook, it would need to break above R1 with the next potential target for the bulls being the R2 level at the $296 mark. Let's see. We have time to do one more. Banco Santander, Deutsche Bank, Amazon, or Apple. Apple might be interesting. It's relatively unchanged, but with slight bearish tendencies during yesterday's trading session. Could be due to the fact that it's been reported that the new iPhones are overheating, and in particular the regular model, not the Pro or Max, which is made from titanium alloys. So that's not the issue. The pure ones are apparently overheating, and it was said by news reports that the new update would not be fixing that issue. So if we're seeing more and more iPhones overheating, potentially causing issues for consumers, and in the extreme scenario, if there's a recall, then we may see the company stock price moving lower. So we're just reevaluating our support levels. 182. Actually, I wanted to coincide with Doji as well. $2.65. Let's make these slightly bigger. And then S1, S2, and S3 need to be altered as well. Still far too close. S3 with S2. Much better. So S1 at 169. S2 at 162. S3 at 154. Perhaps a slightly sideways fashion. Well, as we said, if there's a recall of it, or if more and more iPhones are having this issue, or if they have to recall them, we may see the stock price moving in a downwards fashion. For Airbus, we're seeing some companies reporting that some of their planes had flown with the defunct, well, falsified records of AOG, if I'm not mistaken, a company that sold spare parts for airplanes that was using falsified certification records. The longer this continues and the more news that come out, which are attributed to the selling of faulty parts, could weigh on the stock price of Airbus and Boeing as well, even though it was not their fault. It is still their planes, and those planes, in the unlikely event that something does happen whilst one of these planes is in the air with a default part, excuse me, with a defunct part that was sold illegally by another company, it could weigh on Boeing and Airbus as well, even though they are not to blame. But let's look at the chart. So on the daily, moving lower, I'd be maintaining a bearish outlook. It tested us S1 at 122.15, potentially coming back up higher. It broke above R1, came down, broke again once below, perhaps came to the mid range of the Bollinger Bands for a small market correction before moving lower. So I'd be maintaining a bearish outlook for the company stock price. I'll be looking at Google. Let's do another FX pair. New Zealand dollar against the US dollar, so the Kiwi. So the issue with the Kiwi, well, not issue. You might be wondering why it's moving in a slightly downwards fashion. The RBNZ during today's Asian session stated that they will be remaining on hold, as was widely expected by market analysts. It is currently testing resistance at the 0.5895 S1 level. These were prior support and resistance levels. Let's just clear this as well. So this would be my S1, and then for S2, around here, S2, and then for S3, swing low. Validated by the wicks, yes. So S2 would be 0.5785. S3 0.56668. And then for R1, keep in mind that the RBNZ also indicated that they may not be hiking in the future, which may have further weight on the Kiwi. 0.0630 for R1. For R2, I'd place a bit far too high. Swing low validated as well. 0.6130. And then for R3, 0.6255. So from a technical perspective, it may be considered that it might be moving in sideways fashion, but for that to happen, in my opinion, it would not break below S1. Actually, let's remove this. For it to move in a sideways fashion, it needs to fail to break below S1, then stay between S1 and R1. For a bearish outlook, which I expect it to continue, breaking below S1 and moving towards S2. On the other hand, for a bullish outlook, breaking above R1 and then moving towards R2. For the euro against the dollar, we've already spoken. For the British pound against crossover cable. So at the beginning of our live technical analysis, it had broken below, maybe made that wick. It's still testing R1. So this will be interesting to watch. And with that, that does it for today. Thank you for watching, and until next time.
Welcome to another IronFX video on an introduction to pips. This time we will focus on the units of everyday trading. And we will start with the smallest unit used, the pip. A pip is an acronym for percentage in point and is actually the smallest unit price movement an exchange rate can make. In other words, a pip refers to the unit we use to calculate the change in value of a currency pair. This is the relative value between two currencies. For example, if the value of the Euro-USD pair moves in from 1.3723 to 1.3724, this means there is an increase of 0.0001 in the exchange rate. This is also referred to as 1 pip. Note that all major currency pairs are priced to the 4th decimal place with the exception of Japanese yen's currency pair that are measured to the 2nd decimal place. Gains and losses are easily calculated based on pips. We just multiply the position size by 0.0001. Let's look at another example. If there is a 10,000 unit mini lot position open and we want to measure the 1 pip movement, we just multiply 10,000 by 0.001. That is 1 pip, which equals $1 per pip. This means that for a position of 10,000 units each time the pair moves by 1 pip, there will be a $1 gain or loss depending on the way it moved. Put simply, if the Euro-USD moves 100 pips in our direction, there will be a $100 profit. This calculation works for everyday trade size. Simply multiply the trade size by 0.001 or 0.01 for yen currency pairs. We hope you enjoyed this video. Stay tuned for the next one.
Okay, thanks for waiting, everyone. Let's go ahead and get started. So, first things first, a risk warning as per usual. Our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so I'm Melanie and I will be your speaker for today. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, so here's our agenda for today. So we're just going to get right into chart patterns, looking at the top 3 reversal chart patterns and the top 3 continuation chart patterns. And then we're going to look at how we can incorporate them into a strategy. If we have time after that, which we probably should have, we'll then do a recap of Fibonacci and market structure, because then that leads us into other types of patterns, such as your harmonic patterns and your Elliott wave patterns as well. So we're just going to add a bit of bonus for this webinar as well. So if you have any questions throughout the webinar, feel free to let me know in the chat. And yeah, let's go ahead and get right into it. Okay, so what exactly are chart patterns? So chart patterns are visual representations of historic movements in financial markets. So in your stocks, currencies, so like your forex, commodities, so on and so forth. And these patterns are used by traders and analysts to make predictions about future price movements. So the patterns are the distinct formations that's formed by the movements of security prices on a chart, and they serve as the foundation of technical analysis. So a pattern is defined by a line that connects common price points such as closing prices, highs or lows over a specific time period. So technical analysis and chartists look for patterns in order to forecast the future direction of a security's price. So these patterns can range from the simple to complex, such as double head and shoulders formations. So let's now look at the top 3 reversal chart patterns. So these chart patterns basically indicate that there will be a reversal in trend. And of course, you would know that there are a lot of different ways for you to identify a trend reversal. But these chart patterns are our top 3 ways. Of course, you should use these not on their own, but also in combination with other technical analysis methods. So like your indicators, your moving averages, MACD, so on and so forth, or even your support and resistance levels, Fibonacci. Yeah, so if you manage to get a confluence area, which means there are multiple indicators that tell you that a trend is reversing, that's a bonus, and it's more likely that what you expect would likely to happen. So firstly, we have a double top. So a double top is a chart pattern where the price reaches a high twice, as you can see from the image that I've shown here. So we have one top and 2 tops, and it fails to break out higher during the second attempt. So you can see that it reverses off of that same swing high resistance. So the pattern comprises of 2 peaks of nearly the same size and a bottom between them. So the bottom would just be this valley area over here. And then the neckline is where we measure that support level from the bottom of that valley, I mean. So the line running through the tops is the resistance line, which should be nearly horizontal. And the pattern forms an M shape and is considered a bearish reversal chart pattern. So the pullback between the 2 highs should be moderate. So the pullback is just over here. And the new minor support level is then called the neckline or the support level. And then the pattern is confirmed once the price breaches the low of the pullback between the 2 highs. So basically, once it breaks out of this neckline area or the swing low support over here. Okay, so I've also included a candlestick formation of what I'm talking about here. So you can see based off of the chart, we have two swing highs that are about the same, or rather it's about horizontal. And then we have the valley that I was talking about earlier, which forms our neckline. And then eventually when it breaks out of that neckline, which means just over here, this area here, then that's our double top formation, or rather double top conformation. Okay, next, let's take a look at double bottom. So a double bottom is a chart where the price holds a low two times and fails to break lower during the second attempt and instead continues higher. So yes, you can kind of say that this is the opposite of a double top. So the pattern is characterized by a distinct drop in price, followed by a slight reversal or bounce, with a second drop occurring soon after to either the same or similar level as the first before another. Significant reversal so that the chart appears to take on the form of the letter W. So kind of opposite of double top, we have the neckline, instead of being on the bottom, it's on the top. And then instead of having two tops, we have two bottoms. The double bottom conformation, similarly to double top, happens once price surpasses the neckline. Okay, so the double bottom reflects very strong levels of support, as you can see here. Okay, strong levels of support often indicates a strong change of trend. So that's why you can see once we see price breaking out of here, we can then assume that price has reversed and we're expecting price to continue upwards instead of continue to hit this strong support level here. So double bottoms appear in a downtrend and reverse it to the upside as price breaks through the resistance line. So in this case, our resistance line is the neckline here. So once again, I've included a candlestick example for you to take a look at. Our double bottom has these two, I was gonna say heads, but in this case, I guess they are um, kind of swing lows in this case. So our swing lows also form a almost horizontal or horizontal level, and that's kind of what you're looking for over here. It's okay if it exceeds by a little bit, as you can see from our example, but it should be approximately horizontal for you to take note of it. So you can take note of the entire length of the wick and not, you don't have to just measure it from the body of the candlestick. And then once price breaks out of this neckline or this resistance level, then we can say that there is a double bottom confirmation. Okay, so far pretty straightforward patterns. Next, let's take a look at heads and shoulders. So this is also pretty common. And the head and shoulders is a chart pattern that's described by three peaks. The outside two are close in height and the middle is the highest. So it's a bearish reversal chart pattern. And this begins with an uptrend with two higher highs. So you can see from the example here, I have the higher highs here would be number 1 and number 3, and the two higher lows. So the two higher lows here will be 2 and 4, and these form the left shoulder and the head. So the left shoulder is here, the head is here. Point 5 over here makes a lower high, which is lower than points 3 and 1, and this forms the right shoulder. Okay, and the downward confirmation occurs when price breaks out of this point number 6 here. So we have higher lows from 2 and 4, and that's where we can draw our line across. Once price breaks out of here, then we can say that there is a confirmation that there is bearish reversal happening here. Similarly, I've included a candlestick example here. So same thing, we have, if you implement this diagram onto our real life example on our candlestick chart, point 1 would be here, point 3 here, and point 5 here. So if I were to draw or to measure out a horizontal line. Well, it doesn't have to be horizontal, just a line that extends out of connecting these two swing lows. Okay, so if I extend it out line, then we have confirmation that price is going to continue lower. Pretty straightforward. Let me know if you guys have any questions, of course, but yeah, pretty straightforward so far. Next, let's take a look at the top 3 continuation chart patterns. So the previous 3 we looked at were for reversal purposes. Now we're going to see how we know if price is going to continue in its direction. So firstly, we have falling wedge. So all these chart patterns I'm going through now are pretty popular and quite easy to spot on your charts. Later on, when I go through some harmonics and Elliott wave patterns, those are a little bit harder to spot. But yeah, we'll go through those shapes and patterns later on. Okay, so next, let's go into falling wedge. So this is the pattern that I've included here. This is the pattern for you to take note of when you are spotting a falling wedge. So the entry, excuse me, we go for a target that's at least the size of the chart pattern for wedges and rectangles. So in the next slide, we have a rectangle as well. So we go for the target that is at least the size of it. So what we mean by that is, if you take a look at the real life example here, okay, it might be a little bit different from this diagram that I have here. But basically what happens is you have this price moving upwards, and then you have price making lower highs. Okay, so it's making lower highs, whereas our bottom line, or rather the swing lows, if you connect the swing lows, it gives you an approximately horizontal level. Similarly to before, doesn't have to be horizontal, just approximately horizontal is fine. So that would be our stop loss. Okay, once we have this level that we have connected all of the swing highs, that is our entry level. And then we're going in for our take profit or target level would just be slightly above that. So because we're expecting price to break out of this shape, this higher resistance level here. So the upper red line, that's our resistance level, and we are expecting price to break out of it. Because there's a lot of downward pressure that's pushing on this area or this shape, so we're expecting price to break out, and that's why our take profit would be a little bit higher up. So that's why I've arranged the levels in this way for you guys to see. Okay, I hope I explained that properly, but let me know if you guys have any questions. Basically, if you draw out the shapes here, it would connect these 3 swing highs. If we ignore this area here, because we're expecting price to break out and hit our take profit there. So in the meantime, we'll just look at these 3 swing highs, connect these levels, and then on our bottom, we have our stop loss, and the stop loss is achieved by connecting the swing lows instead. So we connect the swing lows, that's our stop loss, and then we proceed with our entry. So we go in with our buy entry from this level, and then we see it shoot up to our take profit here. Okay. Okay, if we have time after the slides, we'll definitely take a look at some setups, and I'll definitely take a look at gold. But because this webinar is for chart patterns, so we'll take a look at our slides first. If we have time, then I will take a look at gold. Okay. So our next continuation pattern that we want to talk about is bullish rectangle. Similarly for bearish as well, it's about the same, just opposite areas, or rather opposite direction. So in this case, our bullish rectangle, we have 3 swing highs, so it doesn't have to be 3. If you can see in our example with the candlesticks, it's just a consolidated area in which price is testing the upper boundary and the lower boundary of resistance and support level. So if you connect this area here, it's pretty easy to spot. It's just about the same length of candlesticks and wicks. So our entry would be the upper boundary and our stop loss would be the lower boundary. And then we are expecting price to break out of this consolidated area, break out of it, and hit our take profit. Okay, so that's for a bullish rectangle. If we're talking about a bearish rectangle, for example, we can expect our diagram to be the opposite. So instead of price moving upwards, we expect price to move downwards. Same thing though, our entry level instead would be our stop loss, and our stop loss instead would be our entry, or rather our sell entry. And then once we're expecting price to break out of the consolidated area downwards towards our take profit, which would be, of course, lower than our entry level. Okay, so obviously for bullish rectangle, we're going in for a buy, and for our bearish rectangle, we'll be going in for a sell entry. Okay, next, let's take a look at bullish pennants. So for bullish pennants, some people call this flag shape as well. So yeah, it's entirely up to you what you want to call it, but it's all about the same. So for a bullish flag, we have this shape here. Once again, from all of these shapes, we are basically connecting the swing highs with the other swing highs to form a line, and then we see where those lines connect. Oop, sorry about that. So we connect the lines here, and then we connect the bottom lines as well, and then it should give you this flag kind of shape. Okay, so if we're talking about a bullish flag, price will be moving upwards, and then we will expect price. So price is testing within this consolidated triangle area. So we're expecting price to break out of this area and continue in the upward movement. That's why we call it a continuation chart pattern. So price trend is upwards, price is consolidating in this area, and then if we draw out the connect the areas, connect the tops and the bottoms, then we have this flag shape, and then the next step would be to measure out your take profit. Okay, so your take profit would be, as we mentioned earlier, either the size of the same size of your shape, or bigger. So as you can see here, our shape is yeah, you can see the size of our shape here. So our take profit would be times 2 of that. So we would measure our take profit over here. Or rather, we would put our take profit over here. Okay, so for a bearish pennant, on the other hand, same thing, just the opposite. Price will be moving downwards. Okay, instead of our buy entry being over here, we will replace it with our stop loss. And then stop loss, we will replace it with our sell entry. Price will once again consolidate within this area, okay, or within this triangle. Once it's consolidated, we will place our take profit times 2 below that, okay, and then it'll break out of it and then hit our take profit, hopefully. Okay, but that's just how you use this bearish pennant or bearish flag shape. Okay, so that's actually kind of it for the top 3 chart patterns for continuation and reversal. But I wanted to talk a bit about harmonics and Elliott waves as well. Just briefly touch on it if you missed our previous week's webinars. Okay, because when we're talking about chart patterns, even trend lines, support and resistance, all of that are considered chart patterns as well. So yeah, let's just talk a bit about Elliott wave, and harmonics. So before I do that, in order to really understand the harmonics and Elliott wave patterns that we're going to be getting into, I'm just going to do a really quick recap on our Fibonacci, because without Fibonacci, the Elliott wave and harmonic patterns really don't quite make sense. Okay, so we have the different Fibonacci levels here, and if you've been with us for our previous Fibonacci series, we go through in depth the Fibonacci retracement, expansion and extension, as well as projection levels. But for now, I'm just going to briefly go through the retracement levels. So for the negative Fibonacci levels, minus 27.2 and minus 61.8, those are our Fibonacci expansion levels. And then the between 0 to 100 levels, those are considered Fibonacci retracement. And then for the 127.2 and 161.8, or above 100%, those are what we call our Fibonacci extensions. Okay, this GIF here, you can see we are following exactly the pattern, or rather the structure of the market, and that's quite important. So here we show you exactly how to draw your Fibonacci. So for retracement, as you can see from the previous slide, the GIF just follows exactly the shape of the chart. Pretty straightforward. My projection is not showing, I'm not sure why, but I'll show you guys that in a second. Next, if we look at expansions, we're looking for a flash kind of shape. You can see now in this GIF, I'm drawing out exactly this flash shape. Flash or lightning bolt shape, whichever you prefer. So our starting point and ending point for expansions lines up nicely with the head of the lightning bolt. And then for expansions, as I mentioned earlier, we are looking at the negatives. So minus 27 and minus 61.8, if I'm not wrong. So yeah, so we take notes of those levels, and for point 3, it has to retrace at least 50% of your starting and ending points. If we look at our extensions, you can see we've drawn out this Nike tick kind of shape. And that's exactly what we call Fibonacci extensions, the Nike tick formation, because that's what you're looking for. In this case, we have an upright Nike tick, but in the next couple of slides, I'll show you guys examples of inverted Nike ticks and how you can use those as well. For extensions, we are using more than 100% levels, so the 127 and 161.8. Okay, here you can see all the different Fibonacci numbers that we mentioned in our previous slide and how it looks drawn out. So yeah, I think you guys can see for yourselves. Positive Fibonacci retracements are our expansions. Fibonacci retracements are 0 to 100%. Negative Fibonacci levels are what we call our expansions. So more than 100% extensions, less than 0% or negative would be expansion. Okay, so here's an example. I have my Fibonacci retracement. So remember, I mentioned how important it is for us to follow the market structure. So that's exactly what I did here. My starting point here, ending point here, and I'm looking at where price has retraced this level. So this 23.6, 38.2, 50%, these are no longer valid because price has already passed these levels. Okay, instead, I'm taking note of the 61.8 because price has reversed or retraced this level and has reversed off of it. Okay. Okay, here is another example of Fibonacci retracement. Okay, In this case, I'm doing it upside down here. So, oh, am I? No, okay, this is not upside down, sorry. So my starting point here, ending point here. Now I'm seeing once again where my price has retraced to, and I can see my price retraced to the 38.2 level. So I highlighted this level because this dotted line at 32544, it is at this retracement level, but you can see that price also pulls back all the way to this level here, this swing high. So this is what we call an overlap support. So an overlap support is basically when a swing high lines up with a swing low, and it's important because we can see that price, the bulls as well as the bears both respect this area. So that's why it's important, and that's why I've highlighted it here. Okay, so having an overlap support also line up nicely with a Fibonacci level. That's what we call a confluence area. And so we can probably expect price to reverse off of the area as we can see here. So if you have this and then you couple that with your indicators as well as some of the chart patterns that we've mentioned earlier, then you can see there's a higher chance that your analysis will be correct. Okay, so in this example, we have two Fibonacci retracements. So notice how the big Fibonacci retracement trend line price reverses off the 61.8% Fibonacci retracement level. Okay, so my Fibonacci retracement that I was talking about is here. We have the bigger one and the smaller one here. Okay, so both 61.8, but for the bigger one, my 61.8 lines up with the swing high. Okay, and then my smaller Fibonacci retracement, 61.8 as well, lines up with two swing lows. So this once again is an important level because we see that price has respected this level twice. So it's likely to respect this area again in the future. Okay. Okay, next we're going to get into Fibonacci expansions. So an example of expansion and how it plays out, as I mentioned earlier, expansions, we are looking for a flash shape. So this flash symbol also is applicable for Fibonacci projections. So our starting point is here, ending point here for expansions, and we're taking note of the negatives over here. So firstly, my first point, starting point there, ending point there. Number 3, if you can see here, price retraces up to the 61.8% level. So that is our Fibonacci retracement since it's between 0 to 100%. Yeah, so levels, it respects this 61.8, reverses off of it, and it's heading downwards. And in order for us to project where price is heading towards, that's where our negatives come in. We're expecting price to come down to this negative 27.2, where it could bounce off from support. Okay, and you can see this is the aftermath of that, and that's exactly what happened. Price bounced off and reversed off of our negative 27.2. Okay, it bounced off really nicely. And a pro tip is that price usually comes back to this ending point over here. Okay, why does it usually come back? Because as I mentioned earlier, when we have if I were to extend this level, you can see price has tested this level before as well. So we already have two swing lows that line up on the same support level. Now that price has broken out of it, we can expect price to pull back to that level. Okay. Next, we're going to get into Fibonacci extensions. So we are moving a little bit fast because I want to get into the chart patterns for the harmonics and Elliott wave patterns, since this webinar focuses on chart patterns. So I want to quickly get through the Fibonacci recap so that we can get into the patterns. But if you're confused, let me know in the chat. Yeah, but normally we go into depth, in depth um, each of these Fibonacci techniques in our Fibonacci series. So you can stay tuned for those, or you can go onto YouTube and take a look at those as well. Okay, so next we're talking about Fibonacci extensions. So as I mentioned earlier, Fibonacci extensions, we're looking for Nike ticks. Okay, so our starting point is the head, starting and ending point is the head of the tick. And then once price, we're looking at this V shape. Okay, so we're looking for V shape, and the tail of the tick should exceed 100% of the head. Basically, it should be longer than the head. That's what makes a tick, right? So the projected level is either the 127 or 161.8. In this case, price has already broken out of the 127, so we are expecting price to hit towards our projected level of 161.8. And you can see that's exactly what happened here, and a reversal occurred, reversed off of this level and headed back downwards. So it's another indication of a reversal. Once again, you use this in combination with your chart patterns, like the top 3 chart patterns I went through previously, your indicators, and you're good to go. Okay, here is a GIF to show you guys exactly what kind of shape you should be looking for when you are making use of Fibonacci extensions. Okay, so we're looking for reactions off of the 127.2 and 161.8. Once price breaks out of the 127, then you can go ahead and assume that price is going to reverse off of the 161.8. Okay? Yeah, I just let you guys watch the GIF a couple of times and then we can move on. Okay, so we're watching the reaction of the 161.8. Okay, let's move on. So next we have the Fibonacci projection. And excuse me. So we have the Fibonacci projection, and this tool on MT4 is actually the Fibonacci extension tool. Okay, so ultimately, unlike the other 3 methods that we've gone through so far, this method actually requires 3 points. So we need the starting, the middle, and the ending point. Okay, so for this technique, we use namely 3 percentages: 61.8, 78.6, and 100%. But if you're using Elliott wave, we also make use of the 161.8. Okay, for Fibonacci projection, similarly to Fibonacci expansion, we are also looking for the flash zigzag kind of shape or lightning bolt shape, as you can see from this GIF here. Okay, so our starting point here, middle point here, ending point here, we're projecting where price will react off of. And we can see price has already broken out of the 61.8, 78.6, and that's why we can assume that price will reverse off of the 100%. Okay, let's just watch the GIF. Okay, so not included here is the 61.8, 78.6, but we're watching it play off of the 100%. Okay, and you can see it reached our 100% before reversing off of it. Okay, but something I wanted to mention is that you can see that the wick of the candlestick was it like just nice touched our 100% level, which is why it's important that you take note of your trade management strategies as well. You want to make sure that you remember not to put your take profit exactly at your Fibonacci levels or exactly at your confluence areas when you're using indicators, so on and so forth. And that's because price might be it's attracted to these levels, but it's also likely to reverse off of them because of the huge confluence area. So something that we recommend normally is to place your take profit before the level or before a confluence area, basically before where you expect price to hit. And then for your stop loss, you want to make sure that you place it beyond it. So in this case, we would place our take profit higher up, above our 100%, just in case price misses it by a little bit. At least we would have caught that this reversal. Okay. Okay, let's move on. So here's another example. I'm not sure why all of my titles are covered, but here's an example of the Fibonacci projections. So you can see clearly the starting, middle, and ending points here. And these follow the swing highs and the swing lows of price. So it's important for your Fibonacci trend line to follow price movement or market structure really closely. So price has also bounced off of the 100% Fibonacci level over here. So you can see this is our shape, our flash shape, and we're expecting price to go down towards our 100%. You can see it reversed off nicely. Okay, another example. We have a very obvious zigzag or lightning bolt shape over here. So you want to take note of the Fibonacci trend line following the market structure closely. And also we have the 78.6% Fibonacci extension. So because our expansion and our projection use the same shape, more often than not you can use both together and find confluence areas. Okay, so you can see price really bounced off of our 78.6. One more example for you guys. Starting point, middle point, ending point. You can see the shape here. 100%, we're expecting price to hit it, and you can see it reverse off of it nicely. So an invalid Fibonacci retracement occurs when price makes a lower low. Okay, so if there are bars on the right that break your ending point, it becomes invalid. So I'll show you guys what I mean. So this is what we mean. Bars on the right that break out of this lowest point. So because this is no longer the lowest point, it cannot be your ending point. Okay, so we always want to remember to pick the lowest point with nothing on the right of your ending point. So just, this is a bad example to use for a Fibonacci retracement, basically, because price has already broken out of it. Okay? Yeah. So as I mentioned earlier, market structure is really important. You want to make sure that your swing highs and lows are significant levels so that they're good points to use for Fibonacci. And yeah, this is the kind of structure that you want to look for when you are looking for Fibonacci levels, or even when you are doing your analysis, your technical analysis. Okay, I'm just gonna skip through those and get right into pattern identification. Okay, so we mentioned earlier a couple of M's and W's, but we have a couple more patterns just briefly to go through with you guys. So for these lean more towards the harmonics patterns because they're more complex and a little bit more technical to understand compared to the top three patterns that we went through earlier for continuation or for reversal. So you can see instead of our simple M, we also have extended M's, short formed M's, instead of the simple W, as we mentioned earlier, which would be um, our reversal patterns. We now have extended W's and short form W's as well. So they're just slightly more complex to understand, but once you do, they can be spotted really easily as well. So all primary harmonic patterns are 5-point patterns with points X, A, B, C, and D. So similar to what we talked about earlier, we have points 1, 2, 3, 4, 5, and 6. Here we have X, A, B, C, and D. So price swings between these points are interrelated and have harmonic ratios based on Fibonacci, which is why we went through Fibonacci really quickly earlier on. So this is because Fibonacci ratios help traders in defining precise turning points in these patterns. So it tells you exactly where you can expect these swing highs or swing lows or the neckline points that we mentioned earlier that can be used as your entry and exit points. Okay, so we went through a couple of M and Ws earlier, so I'm just gonna move on to show you guys how to identify some patterns. So here are some variations of our M and W points. The breakout points, as we mentioned earlier, happen once price has broken out of the neckline area. So even though it's slightly different, uses a little bit more Fibonacci tools, but ultimately the theory behind it is about the same, or how you use it is about the same. So breakout or upside confirmation basically occurs when price breaks out of this neckline area. If we're talking about a M top, breakout or downward confirmation happens when price breaks out of this neckline. So pretty similar to what we talked about earlier. Okay, so let's talk a little bit about harmonic patterns. So all 5-point harmonic patterns have similar principles and structures, and they differ only by the ratios that are used to identify them and locate their keynotes. So in this case, we have X, A, B, C, and D, as I mentioned earlier. So I've included the Fibonacci levels as well, just for your reference. So from point A to C, it uses 38.2 to 88.6. X and B 61.8, X and D 78.6, and B to D uses more than 100% levels. But that's just for your reference. 5-point harmonic patterns have a critical origin at X, followed by an impulse wave, which is XA. So just the blue line here. So these are followed by a corrective pattern wave to form the EYE of the pattern. So this is at B, okay, completing the AB leg. Then followed by a trend wave at BC, which is another blue line here. Then ignore this line, and finally completed at the corrective leg, CD, and we call this the potential reversal zone. Okay, we call it that because we're expecting price to break out of this neckline area in order to give us downside confirmation. So it's even though it looks a little bit more complicated, it's basically about the same as we talked about earlier. Okay, here is how we use Fibonacci in this case. Possible pattern formation is identified after the first three legs. So XA, AB, and BC. Then we see where exactly we can place our entry level. Normally your entry level would come after this neckline area here, because that's where you get downside confirmation. Okay, the Fibonacci ratio extensions, retracements, and projections are then used to determine the potential reversal zones. All harmonic patterns have a clearly predefined potential reversal zone, and the initiation of new trades should take place in this zone, so over here, and only after price reversal action. So after price breaks out of this B, this B level here. Okay, so a couple of patterns for you to take note of. We have the Gartley pattern. So this is the best known harmonic pattern. So after the impulse wave at XA, the corrective wave, or the corrective leg, sorry, should end at 61.8. Okay, 61.8 retracement of XA. Point C falls anywhere between the 38.2 or 88.6 retracement of the corrective leg of AB, including all harmonic trading ratios that fall between these two constraints. So it can be 50, 61.8, 70.7, 70.6, basically any level, Fibonacci level that's between these two numbers. Okay? And yeah, long positions should be considered after a clear bullish reversal with a stop loss placed below the potential reversal zone. So if we're looking at bullish, your potential reversal zone would happen obviously after this neckline level here. So your potential reversal zone would happen somewhere here. If we're looking at a sell, it would happen after it breaks past the B level. So anywhere after that. Okay. Next, let's take a look at bat pattern. So this is considered the most accurate pattern. And you can see once again it's pretty similar to your W and M patterns. Okay, just with a couple more Fibonacci levels to take note of. So some main rules of the pattern: AB leg can retrace between 38.2 to 50% of the XA leg. The BC leg can retrace between 38.2 to 88.6% of the AB leg. And the CD leg can retrace up to 88.6% of the XA leg. CD leg, so the last leg, can also be an extension of between 161.8 to 261.8 of the AB leg. Okay, it doesn't make sense now that you are just looking at the shape. It just looks like a bunch of numbers. But when you actually try using Fibonacci levels to distinguish the different patterns, it will make more sense then. Okay, and then for the bullish, of course, it's just the opposite of your bearish. So here's an example of a cipher pattern. So cipher pattern uses 38.2% to 61.8 for XB, 127.2 to 141.4. This is for your AC, and for XD, 78.6. And bearish is the opposite of that. Okay, so here is what a cipher pattern looks like on the chart. So you can see it's a little bit more difficult to identify because you would need to take note of the numbers, but ultimately it's still the theory behind it is still the same. Because after it breaks out of this cipher pattern, then we are expecting it to move upwards after it breaks out of this B shape here, or rather this neckline. Once it breaks out of it, that's our potential reversal zone, right? Then it's going upwards, and we can place our take profit, as we mentioned earlier, 2 times the size of your B. So from here to here, this is your potential reversal zone. So times 2 of that will be here. Okay, remember we want to place our take profit before any important levels. So we probably place it somewhere lower just to be safe, just to make sure that we catch that before the reversal occurs. Okay, butterfly patterns. So butterfly pattern requires a retracement of the impulse leg XA by 78.6. Okay, you can take a look here. So I'm just going through the different types of patterns, but there are a lot of different types of patterns. You could probably Google it. But yeah, I'm just going through the different kinds of chart patterns that you can see. Okay, but I think the most important ones are the ones that I talked about at the start. These are just more for your knowledge. Okay, so point C retraces anywhere between 38.2 to 88.6, as you can see here, of the corrective leg AB. Okay, bullish would just be the opposite of that. Crab patterns. So the crab pattern was discussed and released in 2001. So this is an extreme pattern, and the corrective wave AB should end between 38.2 and 61.8, retracement for the impulse leg of XA. Okay, long positions should be considered after a clear bullish reversal with a stop loss placed below the potential reversal zone. So stop loss would probably be somewhere here. Okay, remember the potential reversal zone is basically the area after the neckline area. Okay, bullish sharp pattern. After the impulse wave XA, the corrective leg should end between 38.2 and 61.8% retracement of the impulse leg XA here. Okay. So you can see the arrows. Once price breaks out of this level here, then we're expecting it to reverse. Similarly over here, we're expecting it to reverse. Okay, just some advantages and disadvantages for you to take note of. So they are repeatable, reliable, and do produce high probable setups. And they provide future price projections and stop loss levels as well. And they can be considered as leading indicators. Their trading rules are relatively standardized since we're using Fibonacci ratios. So, and they work on all time frames as well. Okay, some disadvantages are that they are quite complex and technical to understand and master. But like I mentioned earlier, as long as you have the basics or you kind of know what you're looking for, once you master the art of Fibonacci, then you've kind of got it under your belt. Okay. And yeah, that's all I have for you guys today. Thank you guys so much for joining me. I hope you guys found it helpful. And yeah, I will see you guys next week. Thank you guys so much for coming. Have a great rest of your week. Bye, everyone.